Welcome, everyone, to the third in a series of webinars that CRI is hosting to document the effect of the pandemic on the electric utility industry and electrification in general. The title of our presentation, our webinar today is How Will the Pandemic Change the Electric Utility Industry's Regulatory Bargain? A Second Look. For those who are not familiar with CRI, it stands for the Center for Research in Regulated Industries. Its mission is to promote research and scholarship in regulatory economics aimed at improving regulatory policy. The center has been in existence for more than 40 years. It was founded by Dr. Michael Crew, who ran it for about 35 years. CRI focuses basically on a utility regulation, which includes the electric utilities, water, gas, postal, and telecom. This webinar today is a second snapshot. In early June, our panelists answered three basic questions, or at least were tasked with that. And the three questions were, what do you think will be the near-term effect of the pandemic on the operations and the financials of the electric utility industry? The second basic question was, how will government efforts affect, in the COVID crisis, affect the operations of the electric utility industry? The third basic question was, what are the long-term effects of the pandemic, if any, on the operations of the electric utility industry and the regulatory framework? Since they had this webinar in early June, somebody has their speaker on. Please turn it off. Since 2 months have elapsed, the panel will revisit their opinions that they shared with us roughly only a month or so into the pandemic. Now, since 2 months have elapsed, we've also received a lot of specific questions from panelists, from participants and others. And I'm going to categorize them into 4 basic questions, and the panelists have agreed to try to interleave their answers to these questions into their presentations. And the four follow-up questions, which are more specific, are the first one is, what are the benefits and drawbacks of securitization and bill riders to recover revenue shortfalls of the electric utility companies? Then there was a second question that came up, which was a bit more fundamental, and it was the issue of how should the losses associated with the pandemic be shared between the electric utility companies and their customers? Who should shoulder the major portion of that load? The third was to look ahead and assume that the pandemic lasts for 12 to 18 months. What types of performance-based regulations would be useful during this 18-month period that haven't been considered in the past? And finally, the last question is, what are the likely effects of the pandemic on decarbonization and DER policies? The returning panelists are a very distinguished group, and they are Ahmad Faruqui, Kolesar, Jim Lazar, and Bruce Williamson. And if you add me and Victor Glass as the facilitator, among us, we have about 200 years of experience in regulated industries. So you're going to get a very broad and deep perspective on what's going on in during the pandemic. The format that we're going to follow is that there'll be a panel discussion moderated by Ahmad Faruqui. Each panelist will present their views on those three basic questions, interleaving the four other more specific questions, and that will be followed up by open discussion. Okay, so Ahmad, I'll turn it over to you, and then you can turn it over to Mark.
Great. Thank you very much, Victor. It's a pleasure to be back. Sadly, the pandemic is still with us. When we met in early June, we didn't know how long it would last. We had our theories and speculations that it would probably run at least through the summer. And now it seems to be the case that it'll probably run through the end of the year and possibly spill over early into the next year. We are hoping it'll end soon, but this is a case where the hopes are not turning into realities, at least not within months. So as you have laid out, we want to briefly touch upon the three questions we addressed in the early June webinar, and then we have the additional questions that you have gone through. We want to run this particular webinar slightly differently than the first one. What we're going to do is have each panelist address all of the questions in about 15 to 20 minutes of presentation time. And then once all three panelists have given us their thoughts and ideas, we're going to then have an open Q&A session. So roughly speaking, in terms of time management, we're going to allocate between 15 to 20 minutes per panelist, and then we'll have Q&A. I'm expecting that we'll still have about 15 to 20 minutes of Q&A at the end. While you're listening to the presenters, feel free to send your questions to me, and I'll be reviewing them as they come in. And when we begin the open Q&A, I will draw upon that reservoir of questions to begin the conversation, and then we will sort of take it from there. So the way we are going to sequence the presenters is a very simple alphabetical convention, which is by last name. And so we're going to begin with Mark, and then we'll go to Jim, and then Bruce will get to have the last word. Of course, there will be Q&A, so we will all have the last word, I think. Okay, so that's the plan. And why don't we then turn it over to Mark and have him give us his perspective on the questions from the last webinar, as well as the new ones that have been posed today. Mark?
Just before you, Tim Tardif, could you please turn off your video camera?
That's okay. I was kind of liking Tim's new stash there. That looked pretty darn dapper. Okay, I've actually set a timer for myself, if I can get it to work, because I tend to talk long, so I'm going to try to control myself. Anyway, I don't have a lot to add to what we talked about last time, so I'm actually going to jump right into the four main new topics and take my time to actually try to share my thoughts on those. So the first new topic question was, or is, what are the benefits and drawbacks of securitization and bill riders to recover revenue shortfalls? And this is an area that sounds uncomplicated. I mean, it sounds like it would be a relatively easy way to deal with things. I did note on the last call, there was not our call, but the call with the utilities themselves. There was quite a bit of reference to revenue decoupling. And there seemed to be an idea that you could somehow commandeer revenue decoupling for the purposes of ensuring that the utilities had an opportunity to be made whole. It's an interesting idea, but it obviously raises the question as to what's the argument for why you would use a revenue decoupling mechanism in a way that was not originally designed to be used. As I understand them, basically decoupling was a way to fund a utility to be able to implement various public policy objectives that were essentially thrust on them as a result of either changes to legislation or some specific programs that regulators wanted the utility to implement. And so it does sort of raise the question, why do you want to use revenue decoupling, and does it actually make sense? So I think one of the things that regulators are going to have to turn their mind to is what is the real fundamental public policy argument or justification there? And in a more broad sense, when you start talking about securitization, you then start looking at some of the more traditional intergenerational equity issues that regulators are often faced with. So when you start looking at those types of issues, you're really thinking about whether or not it makes sense to take costs that are incurred by a current generation of customers and require future generations of customers to ultimately pay them or carry some of that cost or bear some of that load. And that's a pretty difficult public policy decision to have to make. It seems like an easy fix. We'll just use today's really low interest rates. We'll securitize whatever the shortfalls that the utilities currently incur as a result of the pandemic. We'll add it on to everybody's bill going into the future as some form of rider, and the problem's going to be solved. But there's a lot of assumptions that you have to make in order to implement that kind of a remedy. And the way you have to think about it is as if it were a giant net present value calculation. There's a lot of assumptions about what the future looks like. There's assumptions about what does load look like. There's assumptions about what does the customer mix of the future look like. And in a world where we're starting to look at the traditional monopoly model of the utility starting to break down due to technological change, you really got to ask yourself, is this the right thing to do? Is this the right outcome? Or do you merely shove the problem down the road? So I think it's a rather complex issue that needs to be carefully looked at before we just jump to securitization. The other concern that I would have as a regulator is, if I go to the securitization model, do I start to blunt the incentives that a utility might have to actually try to drive its costs down in response to the situation that it finds itself in? And that, to me, kind of brings us to one of the other questions that we have is, what type of performance-based regulation works in this kind of situation? And I'm, as you probably know, a pretty strong proponent of the benefits of performance-based regulation. I think there's always an advantage to giving the utilities the greatest incentives you can to drive their own costs down, and I really believe that the profit incentive is a good way to get a utility to actually do that. And on our last call, the last call we had, and in fact the last webinar with the utilities, it was very interesting that we heard the utilities talk about all the efforts that they've taken to drive costs down, to find new ways to reduce the cost of the provision of utility services. And one has to hopefully think about a performance-based regulation plan that's going to allow the utilities to take advantage of all the cost-saving alternatives that they've actually found. And my concern about securitization is it may bring the utility back to the fairly simplistic idea that, well, look, we'll just recover all of the shortfall from ratepayers and not give them an opportunity to really take advantage of the kinds of cost reductions that the situation has forced them into, and give them an opportunity not only to implement them for the benefit of their customers, but to implement them for the benefit of their shareholders as well. And so I think there is some serious opportunities and some real thinking that needs to be done about whether or not it's time to start to embrace more performance-based regulation as a way to ultimately deal with this. One of the other questions that was raised was, should the losses associated with the pandemic, how should they be shared as between, I guess, the shareholder of the companies and their customers? Well, I think that really brings up two things. On the one hand, the utilities are in a unique situation relative to every other business in the market. And that unique situation is they cannot exit. Any other company, any other organization in the pandemic can actually exit the market if it's no longer profitable for them to be there. But if I'm a utility and I have an obligation to serve, it's very difficult for me to say, well, I'm just not going to serve. I'm simply going to leave the market. And it brings us back to that fundamental question about what happens to the regulatory bargain. Well, the regulatory bargain says you get an opportunity to recover your prudently incurred costs and earn a fair return in exchange for the obligation to serve. So now, as a regulator, you have to turn your mind to, well, how far does that go? How much do I need to, in effect, save the utility? And that, to me, raises an even more fundamental issue, which is the amount of support that a regulator should be providing. Because if the regulator fails to provide what the market sees as adequate or sufficient support in response to the regulatory bargain, you ultimately end up increasing the perceived regulatory risk that the utility shareholder bears, and that may have an impact on the cost of capital. So it's a very fine line to decide to what extent am I, as a regulator, going to shore up or make whole or protect the shareholder of the utility, recognizing that it's the ratepayers that have to pay for that. I think it's going to raise some really interesting issues for regulators. You have to decide how far do you want to go. And certainly you don't want to end up in a situation where a company is able to take advantage of the situation in order to make a return in excess of what they would ordinarily make. Certainly you would want to find some way that it would be capped at whatever their allowed return that the rates were ultimately based on. That, to me, has to be kind of the benchmark that you want to ultimately go for. And how to get there is really difficult because there's so many moving parts. That then brings me back to the PBR discussion. If you decide that you want to implement performance-based regulation, and you think that there's a possibility that the pandemic may carry on for an indefinite period of time, how do you put enough safeguards into your PBR plan? ordinarily, most PBR plans have certain safeguards built in. You have off ramps, you have reopeners, you have a plan that balances the risk that the utility might get itself into trouble with the objective of trying to create as much incentive for the utility to find newer, better, cheaper ways of getting the job done. So I think as we think about PBR in the future, I think we need to turn our minds much more so to the idea of, if you look at a PBR plan as a total plan with all the pieces that have to fit, you really got to start turning your mind to what do those safeguards need to look like. And you can't have safeguards that unduly blunt the incentives you're trying to put into place, but you need to make sure you have enough safeguards so that you don't increase the regulatory risk. And I'm not sure I have the answer to that issue off the top of my head, but I think it will take some serious looking into. With respect to the effects of the pandemic on decarbonization and policies, with respect to distributed energy resources, part of the issue with those types of policies is they cost money. And if there's not a market-driven response to what we're seeing that makes the implementation of decarbonization and distributed energy resources much more attractive, if it has to be based on a public policy push that costs dollars, one has to question how much of that can you layer on top of all the other implications that the pandemic is bringing about with respect to what people's utility bills are going to ultimately look like. So it may mean that we drive for a more market-based approach to the implementation of distributed energy resources and less of a public policy-driven approach. And we may actually find as a result of that, that the market steps up and we start seeing a shift in the implementation of distributed energy resources, because the market will step in and the market will respond in ways they otherwise might not have responded had they been only required to rely on whatever public policy objectives were being ultimately funded. Because I'm not sure that you can force the additional costs of those decarbonization objectives on a market that's already going to be significantly impacted by the increased cost of the pandemic. So I'm going to cut short here. I would have had about 5 minutes left, but I'm happy to give my 5 minutes to somebody else. I've gone on at some length here, and I'm going to toss it back to you, Ahmad, and invite, I guess, Jim up next. So.
Thank you very much, Mark. Your remarks have certainly prompted several questions in my mind. We also have a question that has been sent to me via chat, but I'm going to save them for sort of the end of the conversation. But thank you very much for your remarks. So, Jim, next. What might you have said differently in early June if you had known what has happened since in the last 2 months?
Well, I don't think I would have said anything differently then. I don't think much has changed. Interest rates are still low. Residential loads are still up. Commercial and industrial loads are still down. Mm-hmm. The primary drivers are unchanged.
Can somebody?
I'll start speaking to the questions, and maybe Ahmad will be able to get my slides up in front of us. The first one is on securitization. There, I think I agree with Mark that securitization is something that If the utility does it and the bonds are issued in the utility's names, the financial markets are going to recognize that as debt of the utility and ultimately require a higher equity capitalization ratio, nullifying the financial benefits to consumers. If alternatively, securitization of any stranded costs is done by the government, and there's actually a full faith and credit of the government behind the securitization. I think that there are some real benefits that can be achieved. The issue of bill riders is another particularly bothers me. We have too many bill riders. Utilities like to have tariff riders in place for costs that are going up, and then have all of the costs that are in base rates be costs that are stable or going down, and that way their rates go up when certain costs go up, but they don't go down when the costs that are prone to going down go down. As for how the losses will be shared, I'll come to that once we get my slides up. I downloaded data on what has happened to loads, and it's no surprise. I was able to get all of this data for the month of April, only some of it for May and only a little bit for June. Residential loads are up nationally by several percent. Commercial and industrial loads are down. The net effect is a slight decrease in loads. But I also downloaded data on what is the average retail rate per kilowatt hour.
There we go.
Oh,
Right.
thank heavens. Okay.
Thank you.
And I don't know why it didn't.
Well, we let the historians deal with that.
Okay, go
So
ahead.
here's kilowatt hour sales for April of 2019 versus 2020. Residential sales in blue went up fairly significantly. Commercial sales in yellow down. Industrial sales in red down. The net is a slight downward effect. And nationally, it's about 4%. So next slide, Victor. But here's the average retail price for residential, commercial, industrial, also from USEIA. Now, they haven't changed very much, but they've all gone down a little bit, and I suspect that's mostly fuel adjustment clauses at work rather than actual regulatory decisions, because fuel costs are down pretty sharply. But basically, the average retail price has stayed about the same for all three classes. So next slide. Now, the market clearing price for electricity is down pretty sharply. This happens to be ISO New England data for April. And I've left the vertical axis off of a lot of this stuff because everything is pretty approximate. And what I'm trying to encourage folks is to do look at your own local data before making any decisions. But market clearing price in New England down about 30%. April in some regions was down more than that, and other regions was not down at all. I looked at 4 different regions, and this one seemed to be the cleanest data that I was able to find for all hours. This decrease in market clearing price is important. If we go to the next slide, if we look at what is the retail margin above the wholesale price, for all 3 classes, the retail margin has gone up. That is, while the rates have gone down, the wholesale costs have gone down even more. So the utility margin above the wholesale price is up a little bit. Now we have to multiply these together. In the next slide, we'll multiply the retail, other direction, Victor. There we go. Slide 4. Here we go. If we multiply the margin per kilowatt hour by the sales by class, we find that the residential margin has gone up sharply. The commercial and industrial margins are virtually unchanged. But the total utility margin measured this way, and this is only one way of measuring margin, this is sort of national average sales data and national average retail rate data, but I picked one region for wholesale cost. We don't have a national wholesale market price data service. Total sales margin is actually up, which should mean that if the margin is up, the profitability should not be significantly impaired. And this brings us to the second of the new questions. How should the losses be shared? Well, first of all, the losses need to be measured to see if they're significant. If they are significant, either in favor of the utility or in favor of the consumer, then that's the sort of thing that normally triggers regulatory action. It could trigger a rate case, it could trigger some kind of special COVID treatment. But one needs to look at all of the components, that is the sales volumes, the wholesale power cost element, and as I discussed in the first webinar, the cost of capital, and I'm not going to update the cost of capital issue. But if there are losses and they're significant enough to impair the utility's ability to provide safe, reliable, and adequate service, then the regulator may need to take some action. I believe there are some parts of the country where that will be the case. I would have expected Ohio to be a state where industrial sales would be a large enough part of the total that this loss of industrial margin might be more serious than the gain of residential margin. I only have one piece of anecdotal data about that. First Energy had its earnings conference call yesterday. Not many utilities have announced second quarter earnings, but First Energy second quarter earnings were about the same as they were a year earlier, which at least for that utility suggests there's probably not a need for regulatory action. We're seeing the other earnings reports from the other utilities over the next few weeks and have a sense of whether First Energy's experience is normal or unusual. Certainly, First Energy is having another experience right now that is anything but normal. The third question is, what is the form of PBR? And I wrote a pretty substantial paper on PBR for a European context that's available on RAP's website. And RAP has a series that was released last year on best practices in performance-based regulation. Yet the performance-based regulation concentrates on the quality of electric service that's provided, the reliability of electric service that's provided, and the total cost of that service. Then it will provide the incentives that we need to give utilities the right signals in any framework, and certainly in the presence of COVID. I would probably be inclined today to increase the emphasis on reliability and service quality from what it might have been in the past. Because so many people are working from home, the reliability of that service is more important, certainly more important to me. And I think a lot of people are in this situation. I watch the evening news and half of the reporters are reporting from their living room. And my local weather service is, my local news weather person is dressing up their corner of their kitchen that they're broadcasting from a little different every night. So that tells me that the reliability of residential service is probably more important. Most studies of reliability values have primarily focused on that reliability value to commercial and industrial customers. And I think that the one thing that COVID is reminding us is that residential service reliability is tremendously reliable. So that's the change I would make with respect to COVID. And the last question is the likely impacts on decarbonization. I think those will be minor, that carbonization is moving forward. The slightly lower loads that we're experiencing are resulting in the earlier retirement of some older generating units that have higher carbon emissions. If they are in the future, there is load growth and they're replaced with newer resources. Virtually any form of new resource is going to be less carboniferous than an older, a 50-year-old power plant that has been retired during the COVID crisis. Mostly that's renewables and combined cycle gas that will come on new, and coal and steam-fired fossil units that will be retired. And so I think that just having a little lag in overall load growth is probably going to be on benefit good for decarbonization. And I think that while I might have finished early without the hiccups that we had along the way, I think I will stop now. That's at my point in the, I've taken my 20 minutes and look forward to my colleagues.
Thank you, Jim. Your remarks have raised a number of very interesting questions. I'm going to save them until Bruce has had his chance to make his comments. So Bruce, you get to make your statements now, and at least from a presentation perspective, have the last word.
All right, thank you. Can we put the slides up? What I've done with this is try to create a very, very high level view of how customers, ratepayers, and utilities and legislators are looking at the problem. And if you graph it this way, you've got choices at one end where you would minimize the delay in recovery of lost revenues. And at the other extreme, you would try to delay that as long as possible or drag it out over time. And actually, there's at least three different situations or contexts that we have to be aware of. First is the balance of legislative interests, and I would not underestimate that for anyone, because that is something that is playing in the elections coming up in a matter of 2 months, 3 months. And then the regulatory utility relationship or a balance of control there, and then the basic economic context that we're all trying to work through. And I'm assuming here that the target, the sweet spot is 100% recovery of uncollected billings for actual customer usage and T&D charges during the moratoria. And then I pose the question in the regulatory bargain, could regulators ask shareholders to eat some or all of the revenue losses? But a footnote at the bottom there, this situation is not to be confused with a situation where the Indiana Regulatory Commission denied the request of 10 utilities to recover for unsold kilowatt hours. That's an entirely different problem. That is something that's often covered with RDM methods, but in this case, what I'm referring to are where actual usage took place, customers used the kilowatt hours, and the utilities have not yet been paid. And when they do get paid, because there are non-payment issues in there with some of the customers hanging over from, let's say, winter disconnect moratoria, that they may never receive full payment for kilowatt hours used. So that's the context I'm speaking about. But this time dimension where, yes, we should pay our bills sooner, or no, let's drag them out for a long period of time, really is playing through several different aspects of society, ratepayers, and our legislators, as well as regulators. So the next slide, please. The three axes I had in there was the economic context, the regulatory utility context, and the balance of state legislative interests. So the economic context, I'll go very lightly over that. We don't know how long the crisis is going to last. We don't know if there's going to be a significant second wave, although we have seen second waves. But and we aren't really fully sure what knock-on effects are going to be in healthcare, schooling, and a bunch of different sectors of the economy, and for that matter, with manufacturing and service industries. In the regulatory and utility context, I want to point out that besides balancing customer and shareholder interests, there's also this theme of our webinar on the regulatory compact. We follow, as you would expect, the basic regulatory principles for sound rate making. For example, known and measurable, fair and reasonable, and so forth. But the matter of entitlement to revenues is something that comes up in every rate case. Some states believe more firmly in a regulatory compact or have at certain points in their time, and other states are quite willing to throw that out and consider that every rate case is a kind of a clean slate. So we also take into account the timing of rate cases and the relative. We do look at what neighboring states customers are paying for electricity. There's always that sense. We look at the allowed and earned ROE and whether it's in the zone of reasonableness. Some of our rate cases, we had 2 significant rate cases at the beginning of the year. So our utilities are not going to be coming back in for rate case consideration, but they certainly are knocking at the door for what to do with accounting or regulatory deferrals to allow them to eventually recover the revenues suspended during the moratorium. I also want to point out in the regulatory context, and something that should not be overlooked, is that there are commissioner appointments, and there's a turnover in commissioners almost every year. By statute, it's typically every 2 years that there's a staggering of terms. But this could change the flavor of what regulators are doing in the United States simply by a different mix in there. And where there's political appointments or where commissioners are elected, they might have a more populist view on some of these issues that the current crop of commissioners may not feel as strongly. So beware, there's a dynamic there that's going to be coming at us. And the last thing is the balance of state legislative interests. Most people don't really realize, and we can thank Stigler for some of the confusion, but regulatory commissions are creatures of legislatures. And every year, a commission will get directives, or they'll get emergency legislation, or they'll get policy initiatives where the PUCs need to act on what the legislature has requested. And we can expect this with a new legislature coming in the spring of 2021. There's also the matter that the legislature controls the either the confirmation or the posting of commissioners. So again, there's a tremendous amount of influence that we can't overlook from the political policy sector. The next slide. So to answer some of the specific questions that were put before us, the securitization, I would agree with Mark. There is a good news to it that the utility revenue deficiency is settled pretty quickly, but there's a whole bunch of minuses associated with it. First, to my mind, it's a mortgage. Ratepayers are saddled with long-term repayment of the missed revenue plus the interest. Yes, there could be an upside depending upon what interest rate you secure versus what the corporate investment grade bond might be, but there's a lot of ifs in that. Secondly, or thirdly, there's the bonding authority in the typical proposals I've seen is external to the PUCs. PUCs are not bonding authority. They might put out an RFP, they might work with a special purpose entity, but they themselves don't collect revenues and repay bonds. That would have to be another entity in the state. Well, that raises the question: is whose risk then is who's at risk in a default? And some of the proposals I've seen say that this authority should go to I think the term was bankruptcy remote entity. Well, if that entity or special purpose entity were to go bankrupt because the utility had another problem that couldn't pay the debt service on the bond, then my hunch is that it falls back to taxpayers and the state. Either way, it could be a burden, it could be a surprise. I'm very, very concerned about the intergenerational transfer that's going on here, where a future generation pays for current customer failure to pay. And this invites a moral hazard problem where if current customers know that by not paying, their debt would be rolled into a future bond and somebody else is going to pay for it in the future and their account, they could change names on the account, then we've got a problem. That's not the best way to solve things. And there's also an inequity with the customer turnover currently from simply move. About 10% of customers are 10 to 12%. And I think with the unemployment rate, we're going to have an even higher percentage of customers changing their addresses during the COVID pandemic. And my last concern is what's going to happen with our consumer-owned utilities? What access to such a bonding or a deferral mechanism do they have? It's a tougher problem with municipals and consumer-owned utilities. As far as bill writers go, I happen to favor them because they are familiar, they're more flexible, and it starts a recovery of revenues sooner for the utility. And I think there's better transparency for ratepayers, for capital markets when those are used. For performance-based regulation, I think it's workable, but I strongly point out the subjectivity in indexing and the fact that the utility may not always be saying everything that what's on their mind, nor may regulators saying or policymakers be saying what's on their mind, because there could be things besides what Jim brought up about rates and reliability of service. There could be things in a performance-based regulation on electrification or distribution build out or this or that, or their targets, goals. And those things might have more qualitative aspects in measurement that would cause problems in a PBR. And fundamentally in incentive-based regulation, I say you have to expect unintended consequences. And there's a footnote to a famous management article. And the last lesson that we've learned in Maine is that PBRs are not set and forget, that there's continuing dynamics in the market that always raises new issues, which are going to have call them back in for hearings and essentially, are you better off in PBR or rate cases? Well, in some cases, I would say rate cases might be, you just get it done and then have a stay out for a few years and they come back in. On the decarbonization, I think that there's some corporate initiatives underway, and I'm surprised at the number of them. For example, NextEra's expansion, greater expansion into renewables to a degree I wouldn't have thought possible 10 years ago. But there's corporate initiatives underway, and there's very large state procurements for distributed generation underway that they're going on whether or not there's a pandemic. So I don't think that we should discount progress that's being made. But I would point out that there's the need for subsidy or continued need for subsidy in getting, let's say, solar or storage in place is going to cause problems because there's questions that would be asked about why are our rates so high, and full disclosure, what says, well, we've got some subsidies in here, and that always some pushback. The carbon tax, I think imposing a carbon tax or rushing to have a carbon tax in the next Congress without an economic recovery is also going to receive pushback. Might be a great idea, but at this time, the timing of it is not good. But I would say it's worthwhile looking at RGGI auction prices, regional greenhouse gas auction prices, which have been creeping up, in the last several auctions, and could suggest that there's a market appetite for emission allowances that are basically signaling that carbon prices are rising. So I think that's pretty much what I was going to say. I look forward to the conversation with my colleagues on the panel and questions from the audience. So thank you very much.
Great, that was very helpful. So let's, several questions have come in. I'll be very brief. I'll ask them. Some of them are directed to individual speakers, but others should feel free to comment as well. So the first question is about securitization, and it's kind of directed at Mark, but it could be addressed by the other two panelists as well. It's a question about intergenerational equity. I think Mark certainly addressed it, and the question is, so is there any, the question is securitization a panacea for the problems created by the pandemic, or is it just a way of transferring the problem from one generation to the other? That's number one. Number two, associated with that, whatever solution utilities come up with seems to ultimately be a solution that will require rates to be raised to recover the lost revenue. And as rates are raised, that might encourage more DERs. And the more DERs that happen, the more the unit cost will rise for the utilities. Wouldn't that set in motion the proverbial spiral that will result in the end of the natural monopoly business? So let me sort of save the other questions and let me leave this with you. And let's begin with Mark. And I'm going to, in the interest of time, request 60-second answers shows, because we have several questions. So Mark, then Jim, and then Bruce. And then there are a few other questions as well. So please be brief, give us sort of the highlights, and let's see how the show goes.
Okay, well, first of all, I think it took you more than that amount of time just to ask it. So it's not a lot of time for us to try to respond. On the question of securitization, I think it's a rather blunt statement to say you just shove the problem down the road. I think if you carefully look at it and you perform the right study to determine whether or not the public interest is served by going the securitization path, I think you could potentially use that as a way to deal with this concern. But as I said, there's a lot of moving parts. There's a lot of assumptions that have to be made. And again, I come back to, look, it's really a complex net present value study that you have to do. And you have to make a determination for yourself as to whether or not, when you look at the full sweep of implications, whether or not the public interest is ultimately served by implementing it. So it's not just a question of shoving the problem down the road. That may actually be the best way to deal with it if you consider that your interest rates today are incredibly low, that if you assume that inflation is going to create an advantage to ratepayers in a future generation because they're paying off the debt with more valuable dollars down the road. But it really comes down to doing it as a really complex net present value and trying to decide what your social discount rate is. And I think it's an exercise that can be done, and I think an exercise that may show that it actually makes sense to go with securitization, but you have to carefully look at it. I know that's a very, probably more time than I should have taken, but I think it's just a complex question that has to be carefully looked at.
Okay, all right, Jim.
Securitization is a blunt tool to be used. A lump of costs would create severe problems for the utility's financial stability. if the utility is required to absorb the costs. In case of COVID, the primary source of that is likely to be deferrals on bills that then become uncollectible. But people wind up, they haven't been shut off during a shut-off moratorium and they can't afford to pay the bill when the bill comes due. I think if regulators properly look at the gain in residential margin, the loss of industrial margin, the decline of the cost of capital, and the other effects that in most cases we won't have such a big lump, the securitization is a relevant tool.
Thank you. Bruce.
All right. You asked two questions, so I'll make my answer to the first short, and that is that yes, there is an intergeneration transfer. Mark's answer and Jim's answer, I agree with it. It's a complex, it's a cost benefit where you can look at the net present value and make some determinations about the likelihood of inflation and other things that might make future payback more beneficial than present payback. The second question about DERs is fascinating. The answer to it, to the questioner's setup, is it depends on what price the DERs are coming into the market at. If the DERs ever wanted an opportunity to undermine utilities, this is that opportunity, but it's at what price? It's not at 15 or 20 cents a kilowatt hour that might be embedded in some states and in some regulatory settings. But on the other hand, if you're coming in at wholesale prices for distributed solar generation, coming in with wholesale prices that are the 2 or 3 or 3.5 cents, then you're talking about a serious form of generation that competes directly with what's being purchased in the wholesale market. So it depends on what price. But yes, I have concerns about a death spiral. It's been talked about for years, but if there ever was an opportunity, this might be it to compete on price.
All right, thank you. So the second question is, there are investor-owned utilities, there are also municipally owned utilities, and there are cooperatives. Are the effects that the panelists have been discussing going to apply equally to those three kinds of utilities? Or do you see some variation in how the utilities will be affected? And let's go in the same sequence, beginning with Mark. And 60 seconds is the target, 90 seconds is with an extension, and 120 seconds is absolutely the limit, then I'll intervene.
You're going to cut me off. Okay, I think it depends on what the individual utility's load profile looks like. So depending on what their customer mix and their load profile looks like, they may not all be impacted in exactly the same way. I found Jim's presentation really interesting, but it assumed a particular load profile in it, and there may be other jurisdictions or other utilities where the load profile looks completely different, and that could mean that the impact on different types of utilities may not be the same. So I don't think there's any easy answer. All things being equal, everybody I think would be affected in essentially the same way, but all things are not equal. Not everybody's customer mix is the same, and not everybody's load profile is the same. So that's, I think you have to look at those specifics in order to make that call for any one entity.
So if I can ask just a quick follow-up question of you and the others as well. What you're saying, Mark, if I heard that correctly, is that the impact will depend on the mix of customers, the load shapes, and other factors that are utility specific. It will not necessarily depend on the ownership structure of the utility. In other words, whether it's a municipal or an investor-owned or a cooperative shouldn't really play a role. It is ultimately the mix of customers and the loads and load shape. Is that a fair translation?
Yes, I think that is true.
Okay, thank you. Jim?
I think the impact on the munis and the co-ops is an important one to think about. Obviously, utility regulators don't usually have to think about those utilities. In a few states, co-ops are regulated, and I think one or two, the regulation of municipals. Most co-ops and municipals have very little debt. Many of them are completely debt-free. Many of them have very generous financial reserves, far beyond the kinds of financial structures that regulators would tolerate for investor-owned utilities, and therefore have more flexibility to manage a decrease in revenues due to a shut-off moratorium, or if their low customer class is heavily commercial and industrial, an actual loss of operating margin. So I think that they will generally be in better shape, but there are a few, particularly newly created municipals, that are very highly leveraged. They start out at 100%, and 40 years later, you find that they're debt-free. So the newest municipals could be in a very different situation. But in general, I think they should be able to handle the suppression of revenue more easily than the investor-owned utilities, because their shareholders aren't expecting quarterly dividends. They get their benefit in the long run in the form of lower rates.
Thank you. Bruce?
I'll start my timer so I can talk quickly. I generally agree, yes, load shape is going to matter on the munis. Munis and co-ops to me are the same sense based on their accounting and their management. The ownership structure doesn't matter. I think it does, because there aren't the shareholders, and I think the obligation or the sense of responsibility and accountability to the customers is very, very close, much more closer in a municipal than it is in an investor-owned utility. But I think there's big locational differences. I think there were about, just a few years old, about 3,000 municipal and co-op utilities in the United States delivering electricity. And I believe that the vast majority of them are rural. Well, where are you going to get your unemployment issues? It's going to be in the rural areas, the lasting unemployment. So I think they are going to be impacted. And what I've heard empirically from the munis in New England is that, yes, indeed, they have their issues with customer non-payment, and they have to work that out, which is why I raised the question earlier about what access to securitization type things do they have to carry them through difficult times. Cash flow is a big problem. So I think it's a serious issue for municipals.
Okay, great.
I wonder if I could jump back in, because I found both Jim's and Bruce's answer interesting. But the thing that struck me was, assuming that their regulated rates have taken into account all of those specific factors that you raised, then the regulatory bargain would say that, well, their opportunity to earn their fair return is a function of those regulated rates that have taken into account that they might be completely debt-free, or they might be completely completely financed by debt. Whatever the impacts on their accounting structure is as a result of the ownership structure should have already been accounted for in their rate structure as it is now. And so they may start from a different place on the track than, say, a purely investor-owned entity, but they're still running the same race, and they're still going to be impacted. But that impact is going to, on their revenues and their returns, is going to be a function of how their customers have been impacted by the pandemic, which brings me back to my point that I'm not sure that the ownership structure matters, because it's probably already been accounted for when their initial rates were put into place, whether regulated or not. So I'm not sure it actually matters. But
so what you're saying is there are several factors in play, and they already have been accounted for. I mean, in general, municipal and cooperative rates tend to be lower than investor-owned utility rates because of all of those circumstances. Again, it's a generalization. It's not always true. Okay, so that was an interesting question. So the other question that follows is Jim showed some data, which what I believe was for the month of April. And there were some questions whether or not that trend that he has highlighted in April has continued in the months that have followed, May, June, and July. July is not over yet, so maybe the data is not there. So the first question, if I can address it to all three speakers, is a comment on the specific numbers that Jim was showing. First of all, do you agree with those given your jurisdictions and your experience? And secondly, is that expected to continue in the months that follow? That's question part A. Part B is, if that is indeed the case, that what we saw in April, that margins are actually good because wholesale costs have fallen quite a bit and retail hasn't changed much. So the question is, does that suggest that there's a failure in the process of regulation as to why reductions in wholesale prices are not being passed on through to retail customers?
Well, I'd like to start on this one because those were my slides. There is newer data on loads, and the loads, I found both April. I used April because that was what I could get everything for. But May and June loads are still down and still showing the same relative shape. And residential loads up, commercial and industrial loads down. The wholesale prices, well, fuel costs are certainly still down. They're not quite as low as they were in April, but they're still down relative to what they were a year ago. So that part of it is stable, but I wasn't able to, I only used one region for a wholesale price in my graphics, and I took the vertical axis off just to make the point that this needs to be looked at jurisdiction by jurisdiction and even utility by utility, because the heavily industrial utility is going to have a very different impact than the heavily residential utility. And finally, on the issue of margins, the margins do change over time, but the residential margin remains over wholesale market clearing prices. Residential margin remains much, much higher than the industrial margin. So 1 kilowatt hour of sales growth on the residential side can make up for maybe 2 kilowatt hours of loss on the industrial side in terms of the utilities net margin. And that's stable. So I think that the results are stable, but they're going to differ utility by utility, region by region, and regulators need to look at local data, not at national data.
Okay, great. So why don't we have Mark go next and then Bruce?
Yeah, I don't have much to add because I don't have any comparable data, but I would say that the situation in Alberta is probably fairly unique compared to what Jim looked at, because we have both competitive retail and competitive generation, and then we have transmission wires companies and distribution wires entities as well, and they're all disaggregated. So trying to come up with an overall margin such as Jim did would be pretty difficult to do here. So I really don't have anything that I can use to really compare with the type of data.
So there was a sort of a subtext there, which is, if there is a reduction in wholesale costs in Alberta, would you expect that to be passed on to retail customers?
Yes, because of the fact that you've got both retail and wholesale competitive markets. The actual cost, the charge for the energy itself is whatever the market rate happens to be at that time. So if that rate has come down, that's going to automatically be passed through. Whether or not there have been cost reductions and changes in the margin for the wires part of the picture, that probably would not have been passed through.
Okay.
It's a mixed bag here.
Yeah, okay, good. Well, thank you. Bruce?
Yeah, I guess I struggle with Tim's concept of margin. I agree with Mark. We've got a market, a restructured market that we have retail competition, and the wholesale price is managed by ISO New England on a competitive market basis. What happens with the T&D costs by the local utilities? It's a cost-based calculation of what the rate should be, and yes, there's a return in it, but the concept of margin I still struggle with. So I don't have any data to compare with his numbers, but I'm just puzzled about it.
Okay, all right. So
I
the,
agree that in the competition states, New England and Texas, the distribution utility is only going to be looking at the distribution margin, and the increase in the margin on the power supply side will not affect the distribution utility.
great, great. Well, thank you. I know there are a couple of other questions, but we are pretty much out of time. Victor, why don't I transfer it back to you for your closing comments?
Thanks very much, Ahmad, and thanks, Jim, Mark, and Bruce for wonderful presentations despite some of the technical glitches. Instead of summarizing, I think I want to end with a different perspective, that you can think of the pandemic as almost like an experiment, a controlled experiment that there's a before and an after. The issue so far is what's the length of the pandemic and its impact on on society. So the treatment isn't as well defined as we'd like, but but eventually, from this discussion, you can see that there are a lot of different opinions, and probably there'll be many different policies pursued throughout the country because the context is different in different geographic areas, different regulatory agreements, different types of incorporation, organizational design, and hopefully what will come out of this is a whole series of experiments where later on people can measure the effects of regulatory policies that try to address the pandemic's effect on the electric utilities. And if we track it well, we could develop some sort of history, or at least knowledge that could be useful, not simply just post-pandemic, but it could be for future generations. So I think all four of you have done a wonderful job in giving us some insights into what are some of the difficulties. And I do think that if we treat it as an experiment and look at the results over time, there's going to be a lot of knowledge produced by examining the effects of the pandemic over several time periods.